Welcome to this deep dive. Our mission today, unpack the recent U-Haul Holding Company earnings call. It's for their fourth quarter and the full fiscal year 2025.
Yep. Think of this as your fast track to the key stuff, the main takeaways from what management said and what analysts were asking.
Exactly. We'll cut through the jargon and get straight to the important bits from that call. Okay, let's get into it.
It was definitely a call with a lot going on. You know, the headline numbers maybe looked a bit rough initially.
Right.
But the conversation really added a lot of necessary context, goes way beyond just that bottom line number.
Absolutely. So let's start right there. Those headline figures that came out yesterday. Q4 fiscal 25, U-Haul reported a loss.
Yeah.
$82.3 million.
Yeah, that's a big contrast to last year's Q4. Back then it was a loss, but tiny, less than $1 million, about $863,000. So quite a swing.
And for the full year, fiscal 2025, earnings landed at $367.1 million.
Which, again, is down quite a bit from fiscal 24. That was $628.7 million.
Per share, that Q4 loss worked out to 41 cents per non-voting share.
Compared to basically zero less than a penny loss last year in Q4. So yeah, the P&L, the net income figure, definitely shows that decline.
Okay, but here's where it gets really interesting, and it's something management really hammered home on the call. They stressed that these Q4 numbers, especially that loss, it's really the result of decisions made years ago finally flowing through the financials.
Right. And despite that reported loss, the core operational cash flow metric, EBITDA, earnings before interest, taxes, depreciation, amortization for their main moving and storage segment actually went up in Q4.
A lot. It jumped from about $5.6 million last year to $217.3 million this year.
Yeah.
Big jump.
That's right. And for the full year, that same moving and storage EBITDA was up too, nearly $52 million higher, hitting $1.6197 billion.
So, okay, this is key, right? If the underlying business operations threw off more cash flow, that EBITDA figure,
Yep.
How did they end up with a lower reported net income and specifically that Q4 loss?
Exactly. That's the puzzle. And management pointed to three main things bridging that gap between the strong EBITDA and the weaker reported earnings.
Okay, what were they?
Well, the biggest one they mentioned was higher fleet depreciation. Now, depreciation, that's the accounting charge for, the cost of trucks wearing out over time.
Spread over their useful life, yeah.
And this increase is purely because they've bought more trucks recently. And crucially, the cost per truck has gone way up over the last few years.
Right, buying more stuff, and the stuff costs more. So that non-cash charge depreciation, it goes up on the income statement.
Even though it relates to building up their physical assets for the long haul.
Makes sense. What was number two?
Second factor was lower gains when they sell off retired equipment, specifically pickups and cargo vans. They're just not getting as much cash back for those lately.
Fewer sales, maybe lower prices per unit, reflecting the used vehicle market, perhaps?
Yeah, could be a mix of factors there.
Yeah.
And the third piece was lower interest income in the moving and storage segment.
So not operational.
No, not really. It's just because they have less cash sitting around short term. They've taken that cash and plowed it back into the business, buying real estate, buying more trucks.
So the cash isn't earning interest in the bank. It's being put to work in assets they hope will generate future revenue.
Exactly. And they actually broke down the impact on the Q4 loss per share. About 16 cents of that 41-cent loss came from the higher fleet depreciation.
Okay.
Another 12 cents was from getting less money back when selling old rental gear.
And the last bit?
Roughly 10 cents was from that drop in interest income because the cash is invested elsewhere now.
So you add those up, and it largely explains the gap, right?
Right.
These specific items, tied heavily to their big investment decisions, pushed down reported net income, even while operational cash flow looks strong.
It's that classic tension, isn't it? Aggressive capital spending, CapEx hits, reported earnings short-term through things like depreciation, but it's meant to build the foundation for future growth.
Let's talk about how the actual business segments performed then. Starting with equipment rental, the trucks and trailers. How did that look in Q4?
Pretty decent, actually. Revenue was up $29 million. That's just over a 4% increase compared to last year's Q4.
Okay.
Though they did note last year's Q4 had an extra day, the leap day, which added maybe $1 million. So underlying growth might have been slightly stronger if you adjust for that.
Fair point. And for the full fiscal year?
Equipment rental revenue was up just over $100 million for the year, about a 2.8% increase.
And are people renting more?
Seems like it. In Q4, they said both one-way moves and in-town rentals saw transaction increases. Plus, revenue per transaction was up, and trailers and towing also did better.
And they gave a little peek into the current quarter.
Yeah, they mentioned April and May revenues were also trending positive compared to last year, so maybe some continued momentum there.
Which, again, ties back to all that investment we were just talking about. Their spending on new rental equipment in fiscal 25 was huge, $1.3 billion.
That's a big number, up $244 million from what they spent in fiscal 24.
But the money coming in from selling old retired equipment actually went down.
Right. Proceeds from selling retired gear dropped by $76 million to $652 million for the year.
Why the drop?
They said it was selling fewer pickups and vans specifically, and maybe getting slightly less per vehicle on average for what they did sell.
And looking forward, still spending big on the fleet.
Looks like it. Their initial forecast for net fleet CapEx, that's new buys minus sales proceeds for this current fiscal year, FY26, is projected at $1.295 billion.
Which is actually slightly up from the $1.211 billion net spend in FY25.
So yeah, even with that depreciation hit, they're signaling continued very high levels of investment in the fleet.
Okay, let's switch to self-storage. That's been a big growth story for them. How's that performing?
Still looking strong. Storage revenues up 8% for the quarter. That's an $18 million lift. And up just under $67 million for the full year, also about 8%.
Are they getting better prices too?
It seems so. Average revenue per occupied square foot was up about 1.6% across the whole portfolio. And for their mature same-store locations, it was even better, up 3%.
And move-in rates.
Also positive. Average move-in rates for the same store group were up over 4.5% compared to last year's Q4.
And they're adding space and filling it.
Yep, the pace of filling units actually accelerated. They added over 39,000 occupied units year over year as of March 25. That's faster than the 31,000 unit gain they saw the year before.
And the physical expansion is just huge, right?
Massive. Fiscal 25 alone. 82 new storage locations, 6.5 million net rentable square feet added, 71,000 new rooms. Just enormous growth.
But adding all that new space, which obviously starts empty, must pull down the average occupancy for the whole system.
It does. The average occupancy across all their own locations dipped about 2.5% in Q4, ending just over 77%.
But what about the established stores?
That's the key distinction. If you only look at the same store portfolio, the mature site's occupancy only dips slightly by 50 basis points. It's still really high at 91.9%.
So that shows the impact of just layering in all those brand new facilities that are still in lease up. The core is staying very full.
And that massive storage build out shows up in their real estate spending. They invested over $1 billion, $1.057 billion in buying property and developing storage and U-Box warehouses in FY25.
Wow, another big increase there too, up $249 million from the prior year.
Just in Q4, they added 1.6 million net rentable square feet, mostly from new builds and expansions.
And the pipeline is still full.
Oh, yeah. Almost 7 million square feet actively under development now, and another 8 million planned behind that. So this big investment cycle in storage isn't over yet.
Okay, what about U-Box, the portable moving and storage containers? How's that doing?
Growing fast. Its revenue is tucked into their other revenue line, but management specifically said U-Box was the main driver behind the almost $14 million increase there in Q4.
Is it both moving and storage with U-Box?
Yes, strong growth in both using the boxes for moves and also customers storing the boxes at a U-Haul site. They've boosted warehouse capacity for these containers by nearly 25% in the last year alone.
And expect more growth there.
Definitely. Interestingly, they noted the moving side of U-Box is growing even faster than the storage side, though both are seeing growth rates up in the 20% plus range.
That's impressive growth.
And management sounds really bullish. They think U-Box can stay in that high growth zone for many years. They see it as a huge, sort of less tapped market compared to trucks.
And importantly, they think it's mostly new business, not just stealing customers from their own trucks.
Right. Largely incremental, which is key.
Okay, let's touch on costs.
Yep.
Operating expenses were up overall.
Yeah, up $53.6 million in the quarter.
Any bright spots?
Well, fleet repair and maintenance costs were down again by $6.7 million. That fits with them getting newer trucks into the fleet.
But other costs went up.
Yes. Personnel costs rose $12.8 million, which they said kind of tracked revenue growth.
Yeah.
And other costs, is things like utilities, property taxes, shipping costs for U-Box, those were up over $11 million.
Any big standouts?
The biggest jump was in liability costs related to the fleet. That was up nearly $28 million just in the quarter, a significant increase.
But even with higher costs and all the spending, their liquidity looks okay.
Seems solid. The moving and storage segment ended March with about $1.35 billion in cash and available credit.
Okay, let's pivot to the Q&A part of the call. What were analysts asking, and what interesting things did management say? How's the consumer looking?
Management sounded, I'd say, cautiously optimistic. They mentioned seeing signs of business picking up pace, seeing optimism at the store level.
Customers willing to accept rate increases?
Apparently, yes, especially when the value is clear. They did contrast that, saying poorly run stores see business drop off, so execution matters.
Makes sense.
Their view is basically a need. The job is to get people needing to move to choose U-Haul. They even tossed out an idea that maybe the distance someone moves could signal how anxious they are feeling financially. Shorter moves meaning more caution, perhaps.
Interesting thought. What about that depreciation issue again? Did they elaborate?
They did, and it was quite revealing. They draw a really sharp line between storage depreciation and equipment depreciation.
I see.
Storage depreciation, in their view, is almost like money in the bank, because it's a non-cash charge on an asset, the building that usually goes up in value over time.
Okay.
But equipment depreciation, for the trucks, they see that as more real because trucks definitely wear out and lose value.
Right.
And they explain that the recent spike in truck depreciation, which they called an anomaly not seen in decades, was due to a couple of things hitting at once. First, the cost to buy new trucks went way higher than they expected. Second, because of equipment shortages, they had to spend more fixing older trucks, which then pushed them to buy even more of the new expensive trucks sooner. That combination drove depreciation way up.
They even took a bit of a swipe at the automakers, didn't they?
Yeah, they suggested automakers were basically subsidizing EVs by charging more for the traditional gas and diesel trucks U-Haul buys. They expect that to calm down as automakers, quote, get done with the charade of net zero and focus back on core manufacturing.
So they see depreciation normalizing eventually.
Yes, they expect it to get back in line with revenue over time. They mentioned tariffs as a potential factor, but interestingly, said overall construction costs for storage have actually been easing a bit for them.
And are those potential tariffs impacting customer decisions now?
Management said they haven't really seen it. They think customer willingness to move is much more about the value U-Haul offers and how well the local store performs.
What about U-Box? Still confident in that 20% plus growth?
Very confident. They repeated that they see it sustaining that rate for many years. Huge potential, largely new customers.
And the spending on real estate, is that slowing down at all?
Maybe shifting focus slightly. They talked about moving away from what sounded like an emergency build-out phase, especially for U-Box warehouse space, towards more calmly developing their existing land and focusing on driving transactions.
And construction costs are behaving.
Seems so. They said steel and concrete haven't seen big tariff hits yet, and overall costs have been coming down gradually, partly due to their own processes improving and contractors getting more competitive, sharpening their pencil, was the phrase.
So still big investment, but maybe less frantic.
That was the sense. The FY26 net CapEx number is still huge, so plenty of investment, but maybe a bit more measured pace than the absolute peak.
How quickly are the new storage places filling up?
They said the first 3-4 years, they lease up well, hitting targets, getting towards that 70% occupancy needed to cover costs. The slight slowdown they sometimes see, if you ignore the weird COVID years, is getting from the low 80s occupancy up into the low 90s, maybe in years 4 or 5.
And they see that as a management challenge.
More of a management execution thing than a lack of demand, yeah? Getting those last spots filled.
Now, they also talked about how the market values their storage business, right?
Yes, they feel there's a disconnect. They think the market isn't giving their massive storage portfolio enough credit compared to, say, pure play storage REITs.
So they think it's undervalued.
Pretty clearly, yes. And they said they're trying to give out more info to help investors see that value.
Which leads to the question of share buybacks, I suppose, if the stock's undervalued.
Exactly. It came up. Management sounded, well, torn was the word they used. They mentioned past buybacks didn't necessarily translate into more cash for the controlling family shareholders, and they also prioritize having plenty of cash on hand because they see uncertainty in the financial markets.
So no buyback planned right now.
No current proposal is before the board. They did acknowledge the argument, though, that the valuation gap looks much wider now than maybe 10 years ago, making the case for buybacks stronger purely on the numbers.
What about their insurance business, the property and casualty side? Its profit dipped.
Yeah, they explained that was mainly an accounting thing. GAAP rules force them to mark their stock investments to market each quarter. So if the stock market goes down, their reported P&C profit takes a hit on paper, even if the underlying insurance business is fine.
It's just investment portfolio volatility.
Exactly. An analyst asked if they'd consider selling that P&C business, maybe use the cash for buybacks or reinvesting in trucks and storage.
And the answer?
Management called it a valid consideration, said it's something being discussed, but definitely not a confirmed plan right now.
Okay, last big topic. The fleet itself, how old is it? Is it in good shape?
Yeah. They don't track a simple average age. Their main metric is unused mileage, how much life is left in the trucks. They said pre-COVID was their best point. Then things got tough post-COVID with supply issues, forcing them to run trucks longer, driving up repairs.
But it's getting better.
Yes, they expect to be back over 90% of their pre-COVID unused mileage level by the end of this fiscal year, so by March 2026.
And from a customer view, is the fleet okay?
They think so. Not a problem from the customer perspective was the message, but they acknowledge they're paying up for it, which loops right back to that high depreciation we started with.
And they don't think this high cost, higher depreciation environment is permanent.
No, they were pretty clear. They don't see this as a new normal. They expect truck quality and pricing to improve as automakers get past recent disruptions. They also stress that judging truck profitability takes a long time, like 7 or 8 years, and the recent supply chain chaos made that harder to predict.
Okay, so wrapping up the call itself. We've hit the Q4 loss, the lower full-year earnings, but also the reasons depreciation, asset sales, interest income driven by massive investment. We looked at solid performance in rentals and storage, explosive growth in UOX.
Heard management's views on the consumer, the fleet challenges normalizing over time, the big real estate pipeline, and their thinking on valuation, buybacks, and maybe even selling the insurance arm. It's a lot of moving parts.
Definitely. The results are clearly shaped by those huge past and ongoing investments hitting the books now, plus the current operations and, wider economic factors.
Okay, time for our disclaimer.
This is not financial advice, seriously. The information we've discussed is purely for educational and informational purposes, just summarizing a public earnings call. Please don't make any investment decisions based solely on what you heard here.
All investing involves risk. You could lose money. Do your own research. Consult with a qualified financial advisor. Okay, disclaimer done.
So with that out of the way, let's circle back to that core paradox. A business growing its footprint and operational cash flow, but reporting losses because of the accounting impact of those very investments.
Right. You've got huge spending on trucks and storage buildings driving up depreciation now. Management believes this will normalize. They think their storage assets are undervalued by the market. They see U-Box continuing to boom.
So purely as a thought experiment, strictly for illustration, here's a wild but maybe plausible trade idea spun out of this call.
Uh-oh. Here we go.
What if you considered something like long-dated, maybe out-of-the-money call options on UAA? The speculative idea, the thesis would be this. Over the next, say, 2 or 3 years, maybe that huge CapEx cycle starts to ease off a bit.
Okay.
Fleet depreciation starts to normalize, like management expects. The massive asset base, they built all those storage units. The U-Box capacity starts to mature and generate more cash flow. And maybe, just maybe, the market starts valuing those storage and U-Box assets more like their pure-play competitors.
So the bet is that future earnings power and cash flow, unburdened by peak depreciation, combined with a potential re-rating of the asset value, could drive the stock price significantly higher than what today's depreciation-heavy P&L suggests.
Exactly. It's a long-term gamble on execution, on those assets maturing profitably, and on the market eventually looking past the current accounting noise to the underlying value, especially in storage in U-Box.
An interesting way to frame the potential long game, based on the call commentary. Strictly hypothetical, of course.
Of course. So there you have it, a distilled look at U-Haul's latest earnings call. The numbers, the stories behind them, the outlook for the key parts of the business, and management's take on the challenges and opportunities.
It definitely paints a picture of a company deep in a major investment cycle, managing external pressures, but really focused on building long-term assets and getting things right at the ground level, even if it makes the short-term reported profits look messy.
Something to think about as you digest all that information.